Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing JD stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 51 billion market cap. They're trading at $34 a share and they have 1.5 billion shares outstanding. JD.com is a Chinese e-commerce company. It is one of the two massive business-to-customer online retailers in China. That's by transaction volume and revenue. The other big one is Alibaba's Tmall. The company changed its domain name to 360buy.com in 2007 and then to JD.com in 2013. JD has invested in advanced technology and AI delivery through drones, autonomous technology, and robots. They possess the largest drone delivery system in the world. They're currently building a drone delivery airport and autonomous trucks. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. Free cash flow was $4.2 billion in 2020. It dropped 33% into 2021 to $2.8 billion. Then it jumped a lot. It jumped 74%, close to $5 billion in 2022. Up 13% to $5.5 billion in 2023. So things are moving in the right direction. They do have really small margins though. They converted only 4% of their revenue into free cash flow. You would think it'd be a lot higher for a company like this, but maybe in time it will be. They do pay a dividend of 2.28%, which cost them $1.2 billion. So they could afford that because their free cash flow is much higher than that. By the way, all these numbers are in US dollars. I converted the numbers from Chinese yuan to US dollars because we're looking at the ticker that trades in the US. Net income is the profit or loss on the income statement. It's revenue minus expenses. They had their highest in 2020, $7 billion. Then it was negative in 2021, back to positive in 2022, and a big growth from 2022 to 2023, $3.3 billion. Still really low margins. And look how much revenue they're generating. $100 billion. That is ridiculous. They generate more revenue than Alibaba. You probably don't believe me, but they do. I'll show you later. And they're much smaller than Alibaba. And their revenue went up 50% from 100 billion to 150 billion. It grows every single year. Their revenue per share is $99 and their share price is under 34. So their price of sales is like a 0.3. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 72 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $62 billion. We divide that by 1.5 billion shares. We get a calculated stock price of $41. They're trading at $34, so they're trading at an 18% discount. It's a buy according to the model. There are 45 companies in the same industry as JD, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend more than the average and median in CapEx. These are investments in property, plant, and equipment. A low debt-to-equity ratio of 0.3. They pay the highest dividend. Not many people pay a dividend in this industry, but they pay the highest. They generate a lot of free cash flow, $5.5 billion. They rank 5th in market cap, far behind Amazon, Baba, and PDD. But look at their price multiples. They're really undervalued. They're trading at 16 times earnings, 9 times free cash flow, and 0.3 times revenue. Remember earlier, we saw their market cap was 1/3 their revenue. Look how much revenue they generate. Only Amazon is bigger. They generate more revenue than Baba, and Baba is 4 times the size. Because revenue is just one number. The most important number is free cash flow. And actually Baba generates more free cash flow per share, but they're pretty much identical. So if you think Baba is undervalued, check out JD. That might be more undervalued. And they're still growing. Their 5-year annual revenue growth rate is 18%. PDD is number 1 at 79%. C is 74%. If you put $10,000 into this company 10 years ago, you'd be really unhappy if you didn't sell when it hit 50,000. Because now that 10,000 is 18,000. Not a bad return 78% return. But we're never happy, especially when our high point was in the past. Let's go through their press release and learn a little more about their 2023 results. We'll start with their income statement. For the fourth quarter of 2023, revenue of $43 billion. This is US dollars, this column. I'm going to only talk about US dollars since they list it. For all of 2023, $153 billion. Very few companies in the world have over $100 billion of annual revenue. Here's a list of the biggest revenue generating companies in the world. Walmart is number one, of course, then Amazon. And I'll go through the list quickly, but eventually we'll come up on JD. You can see Costco, Chevron, and here's JD. They're 40th in the entire world. And their market cap isn't that big, so there's huge potential. There is risk. They're in China, and I know a lot of people don't like buying Chinese stocks. But they have more revenue than Home Depot, more than Kroger, more than Meta. Meta is $1 trillion company. More than AT&T, more than Nestle, more than Target. Here's a breakdown of the revenue. JD Retail, $133 billion. Logistics, $23 billion. Like Amazon, they're a logistics company. Sure, they have an e-commerce platform, but the special sauce is the logistics. That's the hard part. Anybody can list things on a website, but to have millions and millions of packages in your different warehouses and to find them quickly, to ship them out, but they're not that profitable. At least their margins are pretty small. In retail, their operating income is $5 billion, logistics $140 million. So total operating income $5.2 billion. You can see their margins down here. It's under 4% for JD Retail, 0.6% for logistics. They had $76 billion of sales in electronics and home appliances, $46 billion in general merchandise. They make money on marketing, selling ad space, $12 billion, and logistics, their revenue is $18 billion. So their service revenue is $30 billion, product revenue $122 billion. Product revenue is up less than 1%. Service revenue is up 18%, mostly logistics, up 30%. Like I said earlier, that's a special sauce. Not many people can build a huge logistics company like they did. Everybody and their mother has built a website, but very few companies have created a successful logistics operation. Let's look at their balance sheet. Current assets, $43 billion US dollars. Current liabilities, $37 billion, so they have a solid current ratio. Current ratio is current assets over current liabilities. Cash and short-term investments, about $28 billion. $10 billion of inventory, they always have a lot of inventory on hand. $11 billion of marketable securities. It looks like they have a really solid balance sheet. $89 billion of assets, $47 billion of liabilities, only $4 billion of long-term debt. Doesn't look like they have much debt on their balance sheet. Assets minus liabilities equals equity, $42 billion of equity. They raised $33 billion from selling their business. Let's look at this income statement. It's a little different. $153 billion of revenue. Cost of revenue, $130 billion. Really high expenses. Fulfillment, they spend $9 billion in fulfillment. That's when they receive products, package them up, and ship them out. That's all fulfillment. Marketing, $5.7 billion. They have to market their company, tell people about them. R&D, $2.3 billion. G&A, $1.4 billion. Then they have some impairments, about $700 million of impairments. So their expenses are really high. Only $3.7 billion of operating income, $3.4 billion of net income. And their EPS, earnings per share, is 108. Net income per ADS, 217. That's American Depository Share. So 2 regular shares equals 1 ADS. They have 3.1 billion shares outstanding. Their operating cash flow, $8.4 billion. That's how much cash the company generates from running their day-to-day business. Investing cash flow, negative $8.4 billion, almost identical but opposite. And financing, they had a cash outflow of $800 million. That could be from paying back debt. That's definitely from paying a dividend. That also could be from buying back stock. So their free cash flow is $5.7 billion. Free cash flow is operating cash flow minus CapEx. Inventory turnover is 30.3. The way you calculate that, it's COGS over inventory. Cost of goods sold. You can find that on the income statement. Inventory you find in the balance sheet. You take the 2022 inventory plus the 2023 inventory and then divide by 2. So it's average inventory. That's how many times a company sold and replaced its inventory over a certain period. The lower the inventory turnover, the more it implies a company has weak sales. But if it's really high, that indicates really strong sales, but it could indicate insufficient inventory. So there's definitely a balance, like with anything else. You don't want it too high or too low. Theoretically, the higher the better, as long as you're replacing your inventory quickly and you're not running out of product. Accounts payable turnover is revenue, that's on the income statement. And what do you think it's divided by? Of course, accounts payable. Accounts payable is on the balance sheet. You take your 2022 accounts payable plus your 2023 and then divide by 2. So it's average accounts payable. You always take the average of a balance sheet item in the turnover ratios. So this number quantifies the rate at which they pay their suppliers. So a company wants to generate enough revenue to pay its payables, but they don't want to pay it too fast and miss out on opportunities to use the money to grow their business. So they kind of want to wait till the last minute to pay their payables. That's the ideal situation, or even stretch your credit, as long as you don't get penalized. Then you have accounts receivables turnover. All these numbers are in days. That's revenue over accounts receivables. Usually the higher the better for this. It's the number of times receivables are converted to cash in an accounting period. So when it's really high, it indicates your customers are paying their debts on time. If it gets really low, that could indicate your customers aren't paying their debts, and you probably shouldn't extend them credit. Let's look at them on Simply Wall Street. Its last price, 54 billion market cap. They're up 10% in the past week. That's pretty impressive. Up less than 1% in the past year. Let's see what they say about the company. JD operates as a supply chain-based technology and service provider in China. They sell computers, communication, and consumer electronics products. Also home appliances and general merchandise products comprising food, beverage, and fresh produce, baby and maternity products, furniture and household goods, cosmetics and other personal care items, pharmaceutical and healthcare products, industrial products, books, automobile accessories, apparel and footwear, bags, and jewelry. They also provide online marketplace services for third-party merchants, marketing services, and omni-channel solutions to customers and offline retailers, as well as online healthcare services. They own and manage their logistics facilities and other real estate properties to support third parties. They offer an asset management service. I didn't realize that. They lease storage facilities and engage in the online retail business. They provide data, technology, business, and user management industry solutions to support the digitization of institutions. They also have a technology-driven supply chain solutions and logistics services. They used to be known as 360 Buy. They changed their name to JD in 2014. They were incorporated in 2006, headquartered in Beijing, China. Here's their stock price since they started trading. It looks like they started out at 25 in 2014, ran up to about 50 in 2018, fell to 20 in 2018, and then from 2018 to 2021 it kept rising almost $100. That's its peak in the beginning of 2021, but it's only been downhill since then. It went from 107 and then 3 years later below 20. But in the past 2 months it's up a good amount. It went from 20 to 35. I think there's a lot more upside than downside with this stock. Simply Wall Street's valuation is 52. They say they're 32% undervalued. 37 analysts priced this stock at 40. Their revenue forecast for 2026 is 1.3 trillion Chinese yuan. So in US dollars, you divide by 7, 180 billion US dollars. And their free cash flow forecast is 39 billion, or 5.5 billion US dollars. Their revenue was under 10 billion US dollars in 2013. Look how much it's grown year by year. It's unbelievable. It hit 100 billion in 2020. 700 billion Chinese yuan is 100 billion US dollars. And it keeps going up. Each year is better than the last. They're over 1 trillion, 1.1 trillion. This red line is their debt. The blue line is their equity. You can see how solid their balance sheet is. Their equity is so much higher than their debt. And this green line is their cash. They have a lot more cash than debt. It doesn't get much better than this. They didn't pay a dividend in 2022. They started paying a dividend in 2023. It's currently its highest ever in terms of yield, 2.7%. If you buy the stock now and the stock goes up 3, 4, 5x and they still pay a 2% dividend, your yield would be like 15, 20% because you're going to buy at a lower cost basis. And if they maintain their dividend, then your yield goes up exponentially. 41% of the companies owned by institutions, 39% by the general public, 11% by insiders, and 9% by public companies. The founder owns 11% of the company, Walmart 9%, and there's a lot of big funds and a lot of big Chinese companies that own the stock. They employ a small army. It was 38,000 in 2013. It's up to over 500,000. And the ticker trades on the Nasdaq, Mexican Bolsa, Deutsche Börse, Wiener Börse, London Stock Exchange, the Stock Exchange of Hong Kong, Deutsche Börse, Mexican Bolsa, Buenos Aires, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.